Hedge funds were able to produce positive absolute returns in the second quarter, but lagged global equities. Looking ahead, the backdrop for both remains a little bit uncertain. We're going to find out why right here, right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastore. Thanks for joining us here today. I'm here with my colleague, Sean Sanborn, hedge fund strategist from the Chief Investment Office. Sean, good to see you. Thanks for joining me in the studio.
Thank you for having me, Anthony.
Hedge funds have been a really interesting story. So have the whole market. If you look at the way equities have taken a run, which we're going to talk about today, sort of comparing what's happened with hedge funds with what's happened with equities, with what's happened in the fixed income market. So let me ask you, just to kind of level set us here, Sean, how have hedge funds sort of been able to improve long-term risk-adjusted returns in a multi-asset portfolio? Because as we say, the traditional 60-40 portfolio, 60% equities, 40% fixed income, isn't quite cutting it these days.
Right. And one of the things that hedge funds have been able to do is during historical periods, they've been able to produce pretty strong absolute and relative returns, especially when equities and bonds have underperformed. So I think especially when looking at, a team or even like a chain, you're only as strong as your weakest link. Mm-hmm. So while equities have performed, can perform very well during, very short time periods, they are susceptible to severe stress and losses during, poor market periods and environments. And, given hedge funds' ability to, have a wider investment mandate and capture returns that are not, that can be independent of the overall market direction, they are, very helpful in multi-asset class portfolios during kind of severe stress periods.
Terrific. Let me ask you though, Sean, because I bet a lot of people who are watching this today, they don't think about hedge funds as something they should have in a traditional portfolio, but we recommend like 40, 30, 30. Of course, we're doing the math. 40, 30, 30, where 30% of it would be in alternatives. Why in this current market setting are you saying that hedge fund allocations are beneficial right now to portfolios for clients?
I mean, while equities have had a pretty strong performance to start the year, I think going into the second half, especially equities and bonds, the environment is very uncertain. Mm-hmm. Central banks are moving away from synchronized monetary policy. There's a lot of questions around, if there's going to be a hard landing, a soft landing, or no landing at all. And I think one of the things is hedge funds are able to kind of, again, produce returns that are idiosyncratic of that, as well as kind of can capture some form of returns when volatility has been higher, which we've seen in both equities and bonds.
It's great that you said it that way, because there is sort of a sense of this sort of unknown landscape ahead of us. I think everybody's going to be rewriting the economic textbooks that college students are going to be using for the future based on what's happening right now, or maybe what will happen in the next year. But you said it, hard, soft, no landing. We're not entirely sure, so it's a little bit more of a protection. So given that, what kind of strategies do you recommend right now?
And it's a perfect example last year where, equities and bonds, who tend to be used as counterweights in a portfolio, they both were negative last year. Mm-hmm. So that correlation that is historically been negative it's definitely moving more towards positive. And so within the hedge fund realm, we like more defensive, nimble, and hedge funds that are less sensitive to overall market directionality. So that includes macro, particularly discretionary macro, low net equity long short, multi-strategy, and we've had some growing conviction in credit managers, just given the heightened dislocations we're seeing in credit markets right now.
Terrific. Thank you, Sean. And by the way, for anybody who's watching this, who is hearing Sean give these recommendations, you're not quite sure exactly what it means or how it fits into your own portfolio, make sure you're having conversations with your financial advisor. So let me get back to this with you, Sean. Let's talk about performance, right? Because we all have talked about on this show and others how equities have performed. We know that technology was the tide that lifted all boats. The 7 top names in the S&P really did that. But specific to hedge funds, how has performance been so far in 2023?
Like you said, equities have performed extremely well this year. But I think when you're looking at the overall expectations for hedge funds, they've been very much within that realm. And even when looking under the hood, they've actually performed pretty well, especially when looking at select particular strategies. I think one of the things that should be noted here is, from a relative perspective, almost all hedge fund strategies have kind of been running with lower risk and higher defensive kind of posture and cautious stance positioning when looking at kind of their historical standards. So, some of the trends that you're seeing here is within like equity long short. From a certain perspective, their net exposure is much lower, but they're also, when looking into that hood, you're seeing higher exposure towards more profitable and defensive names, while there's less conviction and outright short exposure to unprofitable and more names that are more prone to economic underperformance and stress.
Right, exactly. And you can see, like, we could pull that chart up again, everybody in the control room. I think it's a really good representation of exactly what Sean is talking about. You can really kind of see the performance here versus equities versus bonds. It really does paint a very strong picture here.
It does. And again, one of the things to mention is really not, while I just mentioned equity long short, it's really across all these strategies, event driven, macro, relative value. They're all taking very defensive exposures and risks. So while they've been able to produce strong absolute returns, that return stream has been very differentiated compared to overall equities and bonds, where you're seeing some negative performance from bonds through the first half of the year.
Thank you, Sean. What about performance positioning? We're just out of July, we're into August, we're heading into the fall. How have things been more recently, and what are we sort of expecting in the next couple of months here before the end of the year?
So these trends have kind of continued with lower overall risk taking. We've seen kind of within equity long short maybe some capitulation to some extent in some of these unprofitable names, again, as the economy maybe moving away from the recessionary expectations that people had for the second half of the year. But we're seeing select event driven and select relative value, really select as well macro and equity long short managers all taking increased risk as conviction has grown in various parts of the markets. But dispersions are pretty high, dislocations are pretty high, and volatility is high. This all tends to be very good for hedge funds moving forward. And I think when you're looking at macro, where looking at this chart here, where there's been very minimal risk really across the whole year, aside from some select kind of inflationary trades around fixed income markets, you're now seeing them kind of increase their exposure to more what I would call like central bank moving away from synchronization trades. So you're positioning kind of in currencies where volatility is increasing, and it's kind of been increasing for the first time in a very long period where volatility has been muted for the past decade or so.
That's great. So, I mean, bottom lining it here, just for our audience, it seems like what you're saying is, look, be selective, but there's a good opportunity and there's benefits to having it in an average investor portfolio, especially when you're looking at what's available and opportunities in the hedge fund market and alternative space in general.
Correct. Yes, they'll definitely boost the overall multi-asset class portfolio.
We love hearing that. That's great. Hey, Sean, thank you very much. I know it can be a very complicated topic for people who don't really understand the hedge fund market, so thanks for coming by and giving us a little bit of a tutorial and giving us your investment perspective here. Good to see you.
Thank you for having me.
Great. Thank you, Sean. And thank you all for joining us. As I mentioned again, make sure you are having conversations with your financial advisor. Some of these topics we know can be kind of complicated, but there are great opportunities here. So make sure you're picking up the phone or you're sending an email to your financial advisor for more. And for information on what we talked about today, plus a lot of other content coming out from my team here at UBS Studios and our Chief Investment Office, visit the Insights website at ubs.com/views. Plus, there's great content on all our various social media platforms, including at UBS Trending, which is our Instagram channel for content that you'll see happening here in the studio and content that you won't find anywhere else. Plus, we're on LinkedIn, Facebook, and Twitter for more information. Thanks, everybody. Until next time, I'm Anthony Pastore. We hope you have a great day, and remember to keep your eyes on what's trending. See you soon.